My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Rethinking the Role of FTR for Renewables. We're grateful to our moderator, Dr. James Kim from the Lawrence Berkeley National Laboratory for today's timely discussion. But first, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services you can see at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speakers, please click Zoom's Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I'd like to introduce you to one of our speakers, Dr. James Kim, who is an energy policy project scientist in the Electricity Markets and Policy Department at the Lawrence Berkeley National Laboratory. We're also grateful to the Lawrence Berkeley National Laboratory for sponsoring today's webinar. James, over to you.
Yeah, and good morning, good afternoon, or good evening all. I am not James Kim. My name is Ryan Weiser. I am also a co-author on this particular bit of work that James will be describing here in a moment. But I wanted to offer a few words of context before turning it over to James for the remainder of the webinar. I should also note that we also have Mark Bolinger on the line here, also a co-author on this work, and he will be helping manage some of the Q&A. And so if folks do have any questions during the course of the webinar, please do insert them into the Q&A box in Zoom. All of you, I'm sure, are quite comfortable with this at this point. I imagine during the course of the webinar that if questions come in that either Mark or I feel like we could easily answer or dispense with, or kind of clarifying questions, we may do so in that Q&A box. But of course, we also hope to leave a little bit of time at the end of the webinar to verbally respond to at least a subset of those questions. And again, Mark will be helping us manage that process. So, but to start with context, again, welcome to this webinar on the role of financial transmission rights in wind-rich electricity markets in the Midwest US. Going to the next slide, James. I think everybody on this webinar certainly well knows that wind and solar have deployed rapidly in recent years. This chart simply shows the scope of that deployment across the United States over the last 10 years in the form of the contribution of wind and solar to annual generation capacity additions, and demonstrates that wind and solar combined have represented over 50% of new generation capacity additions in recent years. Focusing more specifically just on wind and the geographic representation of that wind deployment, it is reasonably well dispersed across the US, with the notable exception of the southeastern portion of the US. But you can also see a very significant geographic concentration in the interior of the country's wind belt. This includes 3 wholesale electricity markets in the form of ERCOT, SPP, and MISO. And perhaps not surprisingly, those are the 3 markets that we focused on in our analysis as well. Of course, that's not the end. There is more wind and solar on the way. This particular graphic illustrates the growth of wind and solar in the US market in the transmission interconnection queues. An early part of the project development process is, in fact, for a project to get into a transmission interconnection queue to better judge the technical and cost implications of interconnecting at various points in the grid. Notably, only a small fraction of these projects will ultimately come online. That could be the subject of an entirely different webinar not this particular webinar, but at least directionally, the data presented on this slide illustrate that interest in the US is high, both for solar capacity additions and wind capacity additions. In the case of coal and natural gas, on the other hand, there has been a decline in the amount of capacity in the nation's interconnection queues in recent years. In addition to growth of wind and solar, it's also notable that the contractual mechanisms to procure wind and solar in the US market has changed over time. A decade ago or so, the vast majority of wind projects as well as solar projects would enter into long-term, typically fixed price power purchase agreements with utilities, oftentimes settled at their local wholesale pricing node, which largely shielded owners and developers from basis risk, yes, but a broad spectrum of other wholesale price risks as well. In more recent years, though, that has shifted. It shifted in part because wind and solar projects are increasingly deployed on a merchant or semi-merchant basis. But even more importantly, there are a large number of power purchase agreements that are now executed not with vertically integrated electric utilities, but instead with corporate players, the Walmarts and Googles of the world. And those corporate PPAs are oftentimes settled at liquid trading hubs, not the local wholesale pricing node associated with the generator. And that feature exposes generators and owners of wind assets to basis risk. The concept that there is a difference in pricing between the local wholesale pricing node and this liquid trading hub at which the contracts are being settled. In addition to being exposed to greater wholesale pricing risk, there is also increasingly observable an impact of wind and solar on wholesale power prices. So if you can move to the next slide, James. And that's just illustrated simply in this particular slide. This slide shows the frequency of negative wholesale electricity prices across the US. I don't want to belabor this particular slide for the purpose of this presentation, but suffice it to say that growing amounts of wind and solar have clearly been impacting wholesale electricity pricing levels and the uncertainty of those prices as well. In response to those impacts, I think we are all well aware that there are active discussions and actions moving towards some level of reform of wholesale power markets. Of course, a lot of focus on energy markets, trying to make those energy markets have greater levels of temporal granularity, greater use of wind and solar forecasts, and simply expanding the geographic scope of those markets. There, of course, has also been a lot of discussion about capacity markets, at least where those markets exist, including a desire to better quantify the capacity contribution of different generation assets under uncertainty, and especially under correlated uncertainties. And as well, there have been reforms of ancillary service markets, moving towards new services and service definitions that are more attuned to wholesale markets that exist today with the different generation assets that are online, but also broader participation, enabling storage and maybe even wind and solar to provide various essential reliability services. Interestingly, though, there really has not been that much design evolution of financial transmission rights, or FTRs. And so that was really the motivation for the work that James Kim will now describe, is that there's been a lot of discussion about energy markets, capacity markets, ancillary service markets, and how to reform those markets to accommodate and appropriately value assets, especially with increasing levels of penetration of wind and solar. But outside of a couple of more academic papers, maybe not that much emphasis on design evolution for FTRs. So that is the motivation. I'm going to get off the stage here, as it were, the virtual stage, and turn it over to James to walk through the methodology and results of our study looking at the possible role of financial transmission rights for wind energy. One final just reminder before turning it over to James is that if you do have any questions during the course of the presentation, please do just insert them into that Q&A box and we will address them as we go along, as well as during the final few minutes of the presentation towards the top of the hour. Okay, James, take it away.
Right. Thank you, Ryan, for the wonderful background. And it set up pretty well on ground for this study. So here is a table of contents that we'll go through today. And the first, we're going to start with the introduction of this study of wind FTR and wind-friendly FTR, so to speak, and more direct motivation, and go through very briefly about the literature and go through the data and method in a bit more detail. And then we're going to introduce the result in 3 parts. The one is the evaluation of basis risk across technologies. And this is the case to measure the basis risk without an FTR. The second is the residual basis risk, is about effectiveness of fixed volume FTRs. And this is the case with FTR, and an FTR that is fixed volume nature that is existing on the market design. And the third is a result about the wind FTR and its effectiveness as an alternative to the fixed volume FTR. And I'm going to talk about what they are for the details in a minute. And we're going to end with conclusions. So here is the introduction and motivation. The power plants with contracts, especially in the corporate PPA environment, they settle at the trading hub and are exposed to the basis risk due to the price difference between the plant node where they sell their energy and the trading hub. As you can see on the top figure, the power plant sells their power at the plant node and the buyer buys at the trading hub. Then the price difference existing between the contracted trading hub and the power plant node is called basis, as Ryan introduced briefly. And this basis risk is defined in the study, especially is weighted basis by generator output as a sum of basis times generation, as you can see on the right bullet points. Well, if the basis risk exists because of the price difference between the plant node and the trading hub, is the basis risk identical or looks at least similar across different generation technologies? Well, it may not be the case. Why? Because the basis risk tend to be more significant and greater for wind power plant, for example, due to its remote location where the transmission constraints are greater. So when you think about some of the CTs and CCs, they are located more closely to the load pocket or trading hub that's more liquid. And the transmission line connecting those 2 points are probably less constrained compared to the wind power plants that is remotely located, and the transmission line constraint tend to be higher, then the price difference also tends to be higher. Then if the basis risks tend to be greater for the wind power plant, why does it matter? Because basis risk introduce additional uncertainty in their contract revenues. As you can see on the left figure, for basis risk of a single wind power plant in Orca, which is a Kichi wind power plant in Orca, which shows it, for 5 years, the basis risk variation tends to be very high. When you see the long-term average line, which is a dotted line, and the monthly average, it just goes up and down and up and down and up and down on every month and every year. Why? Because the basis risk is hard to predict and is very uncertain due to the nature of the electricity market topology, such as unexpected outages of power plants and the transmission lines, and then unexpected weather events, for example, in 2019 and 2020 in our car market. And the high variation of the basis risk challenges the use of the fixed price offset into the PPA to make up for expected basis risk. The corporate PPA, as Ryan just introduced and explained, which is a more frequent type of contract that can magnify this issue, this basis risk and uncertainty issue, since they usually settles at the trading hub where the wind power plants and wind power energy sellers, they're supposed to and usually bear the basis risk in the form of the corporate PPA. So that's where the financial transmission rights enter the picture. when the basis risk is hard to be embedded in a contract, as we just saw in the previous slide, they may want to hedge the basis risk. The financial transmission rights are the financial instrument to hedge the basis risk by fixed volume. It hedges the basis risk by a certain amount of the megawatt they purchase by compensating the price difference between the two different locations times the purchased number of megawatt that you hold. So for example, as you can see on the figure, if you own a 10 megawatt of FTR with a direction, because you have to designate the direction when you purchase the FTR, the direction from the node to hub, and the price difference is $5, then the payout is the $5 per megawatt hour, which is the price difference times the 10 megawatt of the FTR that you own, which is $50. So the fixed volume FTRs, they pay out exactly the price difference times the megawatt that you want to be compensated. And this structure of the fixed volume FTR that you designate a fixed volume of the megawatt hour, a megawatt for the designated time horizon, were originally designed by ISOs and LTOs when the flat profile baseload type generators are the main part of the generation mix. And FTR, the design, I'm talking about like 20 years ago. And in this picture, looks like a great hedging product for the basis risk, since it pays the exact difference by the exact amount of the megawatt. Well, it is the case, but not always. Yes, the fixed volume FTR hedges pretty well for the conventional baseload power plants. However, the fixed volume FTR does not perfectly hedge a transaction involving the variable output such as wind, that leading to a residual basis risk, which is the unhedged basis risk that is defined in this study, even with an FTR. Even though you want to hedge the basis risk, there is a unhedged basis risk that is remained due to your variable generation profile. So what am I talking about? As you can see on the figure, especially the left side of the figure, it is about the baseload power plants with basis in the contract, and they purchased an FTR. So when you see on the figure, the fixed volume FTR can effectively hedge the basis risk for the energy resources if they have a constant generation profile. So when the generation profile is flat, and as I explained in the previous slide, the FTR payout is exactly equal and matches the basis risk, which is the price difference between the trading hub and the plant node, and the residual basis risk, which is the sum of the basis risk of the baseload and the FTR payout, is zero, is flat. So the unhedged basis risk is none. However, in contrast, as you can see on the right side of the figure about the wind, and when the resources output varies over time, so it's not flat profile, it varies and it's very uncertain. And the existing fixed volume FTR doesn't do a good job on hedging the basis risk of the wind power plants because of its variable output, and it creates unhedged basis risk, as you can see on the far right of the figure, which is a residual basis risk. So the same FTR design that is designed 20 years ago when the baseload was the main energy resources, it works well for its purpose in 20 years ago, but it works a little bit differently for the wind, which is getting more dominant resource in the electricity market. So with that knowledge and with that background, we motivated to this study, with the scope of this study is to compare the historical basis risk and the residual basis risk with FTRs in the wind-rich Midwest US across different generation types to compare. And the hypothesis of this study is that the basis risk is greater for wind than the other generation technologies, and that makes FTRs more important for the wind. However, the fixed volume nature of currently existing FTR, as we just saw in the previous slide, make imperfect hedge for the variable resources like wind, and at least a greater residual basis risk compared to the other generation technology type. In this case, a wind-friendly alternative FTR design can be more effective for wind power plants to hedge the basis risk. On our approach, we use historical generation and price data to measure the basis risk and the residual basis risk with and without FTRs, focusing on the Midwest US with the vast amount of the data set, which we will take a look at in a minute. And eventually, the two key metrics used to measure the basis risk and the effectiveness of FTRs are the basis risk level and uncertainty. And we believe this is the first study contributes to quantify and compare the basis risk and the residual basis risk for different technology types using the empirical data that we collected. And here is a key findings, and I want to introduce some of the findings before we getting deeper, and we will come back to this key findings at the end of the presentation. So the wind energy faces from our study the largest basis risk and is growing with wind deployment in the Midwest. The basis risk can lead to losses for contract that settles at the trading hub, where the magnitude of the losses varies from month to month. And the fixed volume nature FTR with existing market design that can effectively hedge the basis risk and reduce its uncertainty for baseload generators. However, it is much less effectively so for the wind. And ISOs and LTOs are responsible for designing FTR products and may need to adjust the design to address ever-growing variable resources that are most impacted by congestion. So alternative flexible varying volume wind-friendly FTRs, such as wind FTR, that will be explained in a minute, can be more useful hedging product for wind-rich Midwest electricity markets in the US. So with that key findings in mind, here is a literature that, as Ryan introduced very briefly, that the literature about the varying volume and flexible FTR designs are very, very thin. So the one literature about varying volume FTR by Bolinger and Hasmus in 2013, and one dispatchable FTR. But other than that, it's just very, very thin. And the literature base from our study has been very little, and I'm very positive and confident this study can contribute in the unique part of this area. And here is the method. And this is a brief overview of the method that used in this study. And this study quantify and compare the basis risk and the residual basis risk using nodal level hourly data for the entire generation and price profiles for multiple technologies in the multiple Midwest ISO LTOs like SPP and ERCOT and MISO, and we collect the data from all the wind power plants and all the other generation technologies in hourly granular level for multiple years. And by the data and by the analysis, the main analysis uses two key metrics. The one is level, and the other one is the uncertainty of the basis risk without an FTR and the residual basis risk with an FTR. And here is more details of the assumptions and data, and I'll leave this slide for the future reference for the sake of time, but we can always come back to this slide if we need more details. And why focus on the Midwest? As we saw in the map, there was a lot of wind power plants in the Midwest, but also the sheer number of capacity has been grown in the Midwest compared to the other regions, as you can see on the left side of the figure. And the right figure represents the selected hubs in the study for MISO, SPP, and ERCOT that are guided by the anecdotal evidence from the domain experts. And one thing to note is that, yes, we selected the hub for 3 hubs in the 3 ISOs and LTOs. And we also conducted some sensitivity analysis, and the result were robust by the different types and different numbers of the hub selections and the locations. So these are the background of the Midwest and our hub selection. And with all that, now we are entering to the main result. And the first part is the evaluation of the basis risk across technologies. And this is the case without FTRs. And This is the snapshot of the basis risk for each individual power plants in the Midwest using the 2019 data. So this is a snapshot. And the left figure is the basis risk for wind, and right one is for all the other generation technologies, so-called non-wind. And as you can see on the map, how to translate this information is that red dots represent the negative basis risk, and the blue dots, on the other hand, represent positive basis risk, as you can see on the temperature bar on the right side of the figure. And the negative basis risk, red dots, they mean that plant node price is lower than the trading hub, and vice versa for the blue dots. And let's just zoom in on this figure, and let's look at the wind power plants in the left side of the figure, especially in the ARCA West and the SPP South, where you can see a lot of red dots that are clustered, and the red intensity is very severe. So which means the basis risk for wind power plants are generally negative and clustered, while it is neutral or positive for the non-wind power plants. So as you can see on the figure on the right side, for the non-wind technologies is generally white, which means they bear very minimal basis risk, or even blue, which means they even have a positive basis risk. And the wind power plants, as we just saw, face the greatest basis risk, and the magnitude is growing trend with increasing wind penetration in the Midwest regions. And the figure here, a historical ISO-wide total basis risk in aggregate for different types of generation technologies. And the way to read this figure is the green lines are the wind power plants, and the other colors are the other technologies. And the green lines, the wind power plants, they face the greatest basis risk in magnitude, and also it is tend to be negative and is growing with increasing wind penetration. So for example, the far left figure is ARCAD from 2019 to 2015 to 2019. And the green line, which is a wind power plants on basis risk in total in ISO level, is trending downward. And it is in tandem with the wind penetration level in ARCAD, as we all know about. And yet, the non-wind power plants tend to be having a smaller magnitude of the basis risk in aggregate, and is often positive. So for example, like in ARCAD, all the other technologies tend to be heading towards the positive side of the basis risk, and all the other markets, they tend to go positive or negative, but the magnitude are a lot less than the wind power plants that bearing the basis risk. Okay, so as we have seen, the wind power plants is disproportionately impacted by basis risk across all three markets in the Midwest. And this figure and this slide is about the basis risk level per megawatt hour, dollar per megawatt hour term across 2015 to 2019. As you can see on the y-axis, and x-axis is for the different technologies. And wind basis risk level is again the green color, which is on the right side of the three figures. And the basis risk level of wind, as you can see on the green colors, is generally negative, and the magnitude is greater again than the other technologies from 2015 to 2019. What does that mean? It can be translated as when, for example, a wind power plant is contracted to sell a power at a trading hub, they can lose from -$2 range from MISO to -$7, $8 range, or $6 on average in the other markets. Why is that happening? The negative basis risk can happen because the wind power plants tend to locate remotely, as we saw in the previous slides, relative to the trading hub, and they can drive a greater basis risk. And again, the magnitudes are smaller for the other technologies for ARCAD and MISO and SPP, but some exceptions, but that's generally the pattern that we observe here. So we just took a look at the level, and how about the uncertainty of the basis risk? And again, the basis risk uncertainty is generally greater for wind and similar to the basis risk level, while the pattern is a little bit unclear, which we'll go into a little bit more detail. The figure, as you can see on the slide, is the basis risk uncertainty across different technology type. And the basis risk uncertainty is defined as a standard deviation of the monthly average basis risk across 2015 to 2019, which is a 60-month data points, the monthly average basis risk in dollar per megawatt hour term, as you can see on the y-axis. And the general patterns, as again, the uncertainty for wind is generally greater than the other technologies. And the patterns, not really clear as in the level, but that's the general pattern that we could observe here. And if the basis risk were stable and predictable, where the standard deviation is like near zero, for example, in this figure, the generator could embed this basis risk in the contract price by an amount of the average basis risk. However, the high variation in basis risk makes this strategy challenging and less effective, which can introduce uncertainty in their expected plant revenue. So these are the cases without FTRs, and here is the case with fixed volume FTRs with existing market design. So the overall summary of this slide is that the annual FTR, the currently existing fixed volume FTR, can nearly eliminate the basis risk for most of the conventional generation technology type. However, it is less effective for wind. So the figure that you're seeing represent the level of the basis risk with and without an FTR, where the FTR is the fixed volume annual FTR. Following the currently existing market design. And the green color bars are the basis risk level without an FTR, and orange color bars are the residual basis risk level with FTR, the annual FTR. And the residual basis risk, as I explained, is the unhedged basis risk with FTR. So you can see the difference between the green color and the orange color is the reduced basis risk when you have an FTR. And the effectiveness of the currently existing FTR to hedge the basis risk is, as you can see, vastly different across different technology types. And as you can see on the coal power plants and nuclear and all that, the fixed volume FTR can nearly eliminate the basis risk for the most conventional generation assets. The orange colors are almost gone, yet it is less effective for the wind, as you can see in the figure. The orange color bar size for the wind is far greater and higher in relative term. Yes, the residual basis risk is reduced by the annual FTR, but it is clearly less effective so when you compare conventional generation assets. So let's zoom in. When you look at the ARCOD, the coal power plants and nuclear power plants, and MISO and SPP too, the basis risk is very high, and the residual basis risk with existing annual FTR, the bar size is very, very low, which means it almost eliminates the basis risk, while the wind power plants, it is reduced, but the effectiveness is very, very different. How about the uncertainty with the existing fixed volume FTR? Well, the fixed volume FTR, they also reduce the uncertainty for the baseload power plants, and they're a lot less effectively so for the wind power plants. And the figure represent here about the uncertainty, which is the same design and format as in the previous slide, except the y-axis is the standard deviation in dollar per megawatt hour term to represent the uncertainty. Again, we see the similar pattern here. The fixed volume FTRs are more effective in reducing the uncertainty of the basis risk for the conventional ones, but not the wind power plants. Yet the pattern is unclear when comparing the wind and the other technologies. Why is that? Because the variation in wind power plants, both time of the day and month to month, diminish the effectiveness of the fixed volume FTRs in reducing the uncertainty in the basis risk. So again, the fixed volume FTR works well for the conventional generation asset to reduce the level uncertainty, However, it is less effectively so in general for the wind to reduce the level and uncertainty of the basis risk by the existing market design following fixed volume FTR. So here is the last set of the result with wind FTR. And what is the effectiveness of the alternative FTR market design, which is more flexible and varying volume relative to the currently existing fixed volume FTR? Well, wind FTR, which I'm going to explain in a minute, reduce the wind residual basis risk more effectively compared to the annual FTR. So what is the wind FTR? The wind FTR in this study is designed and defined as a varying volume hourly FTR following the ISO-wide hourly wind profile for a specific year. And the figure here represents, again, the level of the basis risk for the wind in different cases. The green is without an FTR, so it is just a sheer basis risk. And the orange color is the residual basis risk with a fixed volume annual FTRs. And the purple color is the residual basis risk with wind FTR. And all the case is for the wind power plants only. And as you can see here, the wind FTR is far more effective than the currently existing fixed volume FTR in reducing the basis risk of wind. Yes, that is the case for the level of the basis risk and the residual basis risk for the wind. And how about, again, for the uncertainty? Yes, wind FTRs also reduce the uncertainty in the residual basis risk of the wind power plants. However, the pattern is, again, the less clear compared to the residual basis risk level in the previous slide. It reduced some, but it is not as dramatic as for the basis risk level. And the effectiveness of the wind FTR is reduced, as you see in the figure, is because the difference between the heterogeneous plant level wind profiles and the market-wide wind profile. So when you think about it, the wind is blowing, but it's not the same speed and the same time across the vast ISOs and LTOs. So the plant level wind profiles tend to be different. And this heterogeneity reduces the effectiveness of wind FTR to reduce the uncertainty. Well, so the wind FTR is working very, very well to reduce the level and uncertainty of the basis risk of the wind power plants. And this wind-friendly, varying volume, flexible nature wind FTR is indeed working great. And it's mainly due to the fact that we designed this wind FTR to be ideal for the wind power plants to reduce their basis risk, right? Because the wind FTR is the hourly wind profile on the ISO LTO, and it is indeed ideal for the wind power plants. And I have to note, actually, that we do not actually propose or suggest in any degree to have this FTR, this wind FTR, to be implemented in ISOs and LTOs exactly in this way. However, we think that, as Ryan mentioned in the background slide, the conversation and the dialogue around the FTR is far less frequent than the other market design components like energy and capacity and ancillary service markets, for example. And this set of results and this study may be and can be a great starting point to initiate the related conversations around the FTR for the renewable energies and wind power plants. So with that, I promised at the beginning that I'll come back to the key points. So again, in the Midwest US, the wind energy faces the largest basis risk and is growing with the wind deployment level. And the basis risk can lead to the loss of contracts that settles at the trading hub, like a corporate PPA, where the magnitude of the losses vary from month to month. And the fixed volume FTR can effectively hedge the basis risk and reduce its uncertainty for baseload generators. However, it is much less effectively so for the wind. ISOs and LTOs are responsible for designing FTR products as they did in 20 years ago, and they may need to adjust the design to address ever-growing variable resources that are most impacted by congestion. Alternative flexible volume and varying volume wind-friendly FTR, such as wind FTR in this study, can be more useful hedging products for the wind-rich markets that are located in the Midwest US. So that is the end of the presentation, and I think we can begin the Q&A session.
All right, thank you, James, and hello, everybody. So again, if you do have questions, please type them into Zoom's Q&A function, and we'll try to get through as many of those as we can in the remaining time. There's a good question that came in wondering about FTR options. So the question notes that, well, I'll just read it here. The question says, by default, FTRs are obligations, but PJM and perhaps other ISOs also offer FTR options. Would the options meet the needs of a flexible volume FTR? And James, I don't know if you have any thoughts on that. I have a few kind of starting thoughts on that maybe I'll just throw out there, and then you and perhaps Ryan can also jump in if you have any further thoughts. So I think this is a really interesting question. I guess one thing that makes me think that the options may not be the answer here is that, as James showed, the basis risk for wind is typically negative, pretty consistently so, which I believe means that the wind generator will probably always want to hold the FTR, all else being equal. And I presume these options that are being issued by the ISO, from the generator's perspective, they would be call options, where that would be kind of dependent on, where the strike price would be dependent on the basis. And if the basis is always negative from the wind generator's perspective, or is most of the time negative, then having the option of whether or not to execute on the FTR becomes a little bit less valuable. And I also think that that the option may not address the variability issue, which seems to be the primary challenge facing fixed volume FTRs for wind plants. So I think it's a really interesting question. I'm not sure it's quite the answer, but it is the type of innovation that I think we need to see among the ISOs to lead to products, FTR products that are more appropriately tailored to variable generation. So before we move on, I don't know, James, do you have any thoughts on that?
Yes, so the options can be definitely options. So the FTR, for the audience, the FTR has two types. One is obligation type, that if you purchase the FTR, then you must have the FTR and you have it until the payout period unless you liquidate it somehow. And the option is the call option, so to speak, that you are exercising the FTR function up to your option ability. And yes, that's one other option as an FTR option. I think that's a conundrum, but I think the focus of this study is about the FTR, underlying FTR design as a rigid fixed volume nature. So for example, whether it's obligation or option, when you have, for example, the annual FTR, then you are supposed to holding or seeing the effect of the 10 megawatt of the annual FTR for the 8760 hours throughout the year without changing the volume by or in tandem with your wind profile, for example. So whether it is an obligation or option, I think the nature of the fixed volume FTR is not changing, and the option may have some optionability, but it doesn't solve the problem that we proposed here, I believe.
Okay, great. So someone else has a kind of a more of a mechanical question. The question is, what would be the unit at which an ISO would auction a wind FTR? With fixed volume FTRs, that unit is presumably just the megawatt hours. So James, you want to clarify what units the wind FTRs would be issued in?
Sure. So each ISOs and LTOs, I believe, some people knows a lot more correct numbers, but they also have a smallest unit of the FTR, the currently existing FTR in the auction. So some ISO LTOs, they have more granular units than the other ones, and I believe the wind FTR is not too different. It depends on how they want, but this is the whole wholesale level market, so it's not going down to like a 1 megawatt, for example, or like like very like kilowatt hour level, but it definitely somewhere in line with the currently existing the FTR market design. However, more granular, because we are talking about the varying volume wind that can be very strong in some hours, and some hours can be very not strong. So the minimal unit can be a little bit smaller, but the general granularity and the difference is up to the ISO LTOs, as in the currently existing FTR market design.
Okay, great. The next question, someone points out that fixed volume FTRs are also used by financial participants, so presumably in a speculation type approach. And the question is, how do you envision those financial participants interacting with these variable volume wind FTRs?
Yes, so that's a great question. Thanks, David. Yes, I thought about it, and we even had a conversation about this with some of the industry people when we had initial comments of this study at the very embryo stage. And I believe the ISOs and LTOs, they have a functionality to have more granular and the varying volume FTR-ish market auction, and that is function available in their software at the moment, and it's just a matter of how they execute it and whatnot. And I think coming back to your question about the financial participants and how they are doing that, I think as in all the other financial products in the market, whether it is virtual or up to congestion or the FTRs, it is double-edged sword, and it depends on how you want to use it, how they want to be utilized. But I think it is the FTR design more designed to the wind and the renewable energy friendly, the varying volume, the profile friendly, so to speak, then this FTR tends to be more cheered and excited by those wind power plants owners, for example, to hatch their the base risk with a varying volume FTR, and it is well adopted. And then it will be perhaps if the arbitrageurs and the financial participants see the opportunities, and they will definitely jump in. But the original intention of this type of wind-friendly and renewable-friendly FTRs are to hedge the basis risk for the renewable power plants.
Yeah, and I'll just add on to that. It seems like speculators right now with a fixed volume FTR, they've no doubt become adept at kind of projecting which way that market is going to move, and how they can make money off of those positions. With a wind FTR, it'll be a little bit more challenging, because you have to also factor in the wind generation profile as well. So my guess is it would take a little bit more time for speculators to come up to speed on how the market works and what they need to be looking at. But as James mentioned, I think eventually you probably would see these participants just view this market as any other market where they can potentially make some money through speculation. Another question that came in here is, this study is focused on the US, and the questioner is wondering whether you see similar issues in the EU, the European Union, and if so, whether you know how they address these problems.
Right. So yeah, so this study is about the US and ISOs and LTOs in the US, and the European market also has very high volume of the renewable energy and the wind in some areas. And I believe the European markets, I'm not an expert of the European market, so I cannot really talk very deep into that, but they have a similar mechanism, but not the FTR that are auctioned by ISO LTOs in this fashion, but they have a certain products to hatch the congestion or basis risk in the study. And I believe they also had a similar dialogue internally, but not explicitly about this type of risk. And they also have a similar challenges to have a hedge the basis risk that are exposed to the variable generation fleets like a wind in the study. And they may also have a similar issues that need to be solved, but I'm not sure about their exact market design and how the FTR or similar kind of products are implemented in the European union, the electricity markets. But that's a great question.
Yeah, that is a good question. And I don't have any insight on that either. But it's somewhat related to that question, which involved looking at a different country's market. Just somewhat related, within the US, solar is another variable resource. And I'm just wondering if you have any thoughts, James, on a solar FTR, let's say, and how that might differ from the wind FTR that you've looked at in this study.
Sure. So one simple answer is that if we can solve the problem of the wind or wind FTR like a product, then the solar will be solved automatically. So what am I talking about is that the wind and solar profile, as you can see on the profiles of kind of like standard wind power plants and the solar power plants, the solar power plants, they tend to be very regular and pattern-like. When they have a sun, they will generate. When they have no sun, then there is no generation, and the sun goes up and down. It is recorded in hourly or minute level. It is very regular and is very pattern-like. And the wind profile, on the other hand, they are very stochastic, and you have no idea when the wind is blowing. It is not really in tandem with the sun. It is just a wind with its very uncertain nature. And if we can solve this problem of the wind and its variable generation and its stochasticity over the time horizon, the time of the day or month-to-month variation, and using this wind-friendly wind FTR with a varying volume FTR, and if we can solve the problem of the wind, which is more stochastic, then we can also solve a similar problem for the solar, because they are more pattern following and is less stochastic. And if we can solve the higher challenges and greater challenges with this market design, then the solar, if they face the similar challenges, which I believe they do, they can be automatically solved. So
yeah. And in some sense, it seems like solar should be a little bit easier than wind potentially, because the output tends to be a little bit less variable, and it's concentrated into daylight hours as opposed to throughout the day.
Totally.
So someone had asked earlier while you were presenting, James, about who the typical counterparty is for these FTRs, and I responded in writing that these FTRs are auctioned off by the ISOs, so the ISO is the counterparty, and I think that's correct. But it did get me thinking about whether any secondary markets for FTRs have developed, and so I don't know if you're aware of any activity in that area. And I guess somewhat related to that, one could potentially envision sort of private sector hedge products that might arise that are not the official FTRs that are issued by the ISOs, but might nevertheless help to address basis risk in some way. So do you have any thoughts on either secondary markets or private products?
Sure. So I'll just talk briefly about some of the kind of like offshore markets out there and the pros and cons and how they are operating, and also briefly talk about some of the private markets or secondary markets. So the ICE, the International Exchange market, they have a similar product. It's more like a spread products, but it's basically the spread between the hubs and the liquid trading hubs, and it's very similar to the congestion components of the price. So it is basically very similar to the FTR, but they are only dealing with, since it's an ICE, they more representing the liquid trading hubs rather than the granular node. So when you are interested in traded hubs to hubs or some of the liquid poke to poke, then the ICE may be the place to hedge those the basis risk between the liquid trading hubs. But since the wind especially tend to be located in more remote location in the node that is less known, then the ICE cannot really deal with that. And then if you want to go more granular, then there is a Nodal Exchange. Then you can see more granular of the node, the number of nodes in each market that are dealing with the congestion risk that is happening more frequently. But the problem of the Nodal Exchange is liquid, or how liquid the market is. So you want to say buy or sell a certain FTR products or FTR-like products from one node to the other trading hubs, or to one node to the other node, then you have to have a counterparties on this type of exchange because it's an exchange. So you need to have a counterparty. But the ISO and LTOs, even though they have varying liquidity for each individual, node to hub or hub to hub or node to node, the path, then ISO LTOs have no problem to solve and clear those auctions. So it is more ISO LTO can solve out those problems, but the ICE, they deal with more trading hubs and more representing hubs. And the Nodal Exchange, for example, they have lesser liquid to have a counterparty exchange. And the private markets and secondary markets, yes, those are always existing. All the exotic products, they can be traded, one-to-one, peer-to-peer in the secondary market, but also the liquidation problem. You're supposed to have a counterparty, and finding an exact counterparty that purchase or sell or buy the exact amount of the FTR that you own in the price that you desire, it is really hard to find.
Okay, thanks. So another question here is, you've talked about a fairly specialized design for the wind FTR, and I guess the question is, what are some of the barriers to ISOs, coming along for the ride and making some of these design changes? What's the hesitation on the part of the ISO to implementing a wind FTR?
So yeah, so on that side, we also had a very brief conversation with one of the ISO, not all of them, but definitely one of the ISO in the Midwest. And their technical concern is, there are some, but it is less than the other political concerns. So talking about the technical concern is that it is more like a software. They're always concerned about software and how to implement it technically correctly without having any glitch, because one glitch in the ISO, it impacts all the market participants. And on the technical side, most of the ISOs and LTOs and their FTR software design are capable and to embed and change into those more flexible and varying volume FTR types in their auction market. It is just their software. And I think what they care more and concerned more, if they're concerned at all, is that this change, how they are affected and embraced by the multiple stakeholders. I mean, we're talking about renewable energies in the growing Midwest, but there are the other participants like the coal power plants and gas and the nuclears, and also the buyers and sellers and all the other stakeholders. And they have to bring the agreement to make a market design change by the stakeholder meetings and all the long process they're going through. And they tend to be concerned about different parties and different stakeholders and different voices for these specific design changes, especially when it seems to be the favor of one technology. But what I want to emphasize is that this is the type of the FTR that it can be optionally purchased or sold by their hedging purpose. If they want to hedge, or if they are benefited by this wind FTR, for example, they can participate in this market, and it's optional to them to not to participate. So having these products gives the additional option to hedge their basis risk more effectively rather than harming or affecting the other.
Okay. And I guess one additional question here is, you kind of compared the annual fixed volume FTR to an hourly variable wind FTR. Did you look at anything kind of in between those two extremes, if you will? I guess I'm thinking of, I believe we did look at a kind of a time of day FTR. I don't know if you have a slide on that, James.
Sure. So yeah, totally. And I think it is related to some of the questions that we have got, especially from Dahlia. Thanks, Dahlia, by the way. So this is one of the kind of like alternative FTR that we call it, for example, like monthly peak and off-peak FTR, monthly time of use FTR. And this FTR represents more granular FTR. So the annual FTR, for example, is the annually fixed volume for the 8760 hours, and the month peak FTR in this case, which is orange in this figure, is the year month time of use average plant production. So this is more granular FTR. It is varying volume by the year, month, and time of use. And when you apply this FTR to reduce the basis risk for wind, as you saw in the previous slides, if you remember, and this is the result of the basis risk and the residual basis risk for the wind power plants with no FTR and the annual FTR and the month plus peak FTR and the wind FTR. And even though this month peak FTR design or month's time of use FTR design is a lot more granular than the annual FTR, the difference or the effectiveness is not too different from the very humble and boring, the annual FTR. So what I'm talking about is the design changes of the FTR rather than just, like why not using the currently existing market design and making more, kind of like more looking good. So the revising the existing fixed volume FTR design, as we saw and see in the month plus peak FTR result compared to the annual one, is not likely to be effective to resolve this inherent basis risk issue of the variable generation resources like wind power plants, whether it is obligation or call or put or option. If the fixed volume FTR nature is underlying as a basis, then this problem will continue to persist.
So going part way doesn't necessarily get you to where you want to be if you're a wind generator. So we're at the top of the hour. So thank you everyone for all the great questions, and thanks James for the presentation and Ryan as well. And let's kick it back to you, Dave, for wrap up remarks.
Dave, back over to you.
Thank you, Mark. Thank you, James, as well as Ryan, for a very insightful webinar on the topic of FTR and renewables. Now, this is such a hot topic for the association. I encourage you to stay tuned to additional webinars on the topic, as well as some content that has come out recently in one of our Energy Forum newsletters as well. We want to thank our organizers and thank in particular our host, LBL, for your support in bringing about this webinar. I wish you all a good rest of your day, wherever this finds you on our fine globe. Thank you for listening.
Thank you.